Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about RIG, Transocean Ltd.
Right, and this company, it really sits at a fascinating crossroads, doesn't it? You have this incredible scarcity of deep water assets on one hand, and just crippling financial leverage on the other.
Exactly. We've watched the shares, just persistently trade in that low $4 range. And they're highly sensitive right now to any softness in WTI crude, which has been hovering around, $57 to $58 a barrel?
And that's where the debate really is. The complexity here is profound. I mean, is Transocean this ultimate high beta leveraged call option on an offshore supercycle that has to come? Or is the reality of its immense debt load simply too heavy? Is it an unavoidable value trap?
And that structural question really defines the equity today.
For me, it does. I argue that the core reality is the debt, that $6.22 billion structural liability. It just creates what I see as an insurmountable barrier. The equity, well, it essentially exists as a mechanism to service bondholders. And until that dynamic fundamentally shifts, any true upside for the common shareholders is structurally capped.
I see why you hold that view. I really do. But I approach the risk-reward equation very differently. Transocean's defining strategic decision was avoiding Chapter 11 during that profound downturn. It was a move that crucially preserved the original equity value.
It preserved it, sure, but at what cost?
At the cost of leverage, which makes RIG the highest leverage exposure available to the offshore recovery. My position is justified by scarcity. I mean, we're talking about steel in the water that cannot be easily replicated. New 7th-generation drill ships, assets like the Deepwater Titan, they cost upwards of $1 billion with multi-year lead times. They are, simply put, irreplaceable infrastructure in the deepwater market. The exponential payoff for shareholders is entirely contingent on day rates breaching that crucial $500,000 per day threshold. That is the inflection point, you see. It's what's required for massive free cash flow generation. We're talking operational cash after maintenance and expenses, which can finally shift the focus from merely managing debt to actually addressing the principal. And the activity in the Golden Triangle, Brazil, the Gulf of Mexico, West Africa, it all supports this bullish outcome.
That's a compelling assessment of the asset quality at the premium end. I'll grant you that. However, operational quality alone cannot overcome the risk of a financial insolvency. The structural barrier remains the debt, and the fundamentals are now formally recognizing the liability side of the balance sheet. Just consider the Q3 2025 earnings report. The headline was a massive $1.92 billion net loss, overwhelmingly driven by a non-cash impairment charge of $1.908 billion.
A non-cash charge, though.
But it's more than just an accounting entry. It's management formally admitting that their older legacy rigs are no longer viable assets capable of earning their cost of capital. The old bearish argument, steel rusts, was just financially affirmed. And this fact severely limits any perceived future value for equity holders. The market reflects this. The stock trades at a price-to-book ratio of only about 0.6, signaling a clear institutional preference for peers like Valaris and Noble, which emerged from bankruptcy with balance sheets that are significantly cleaner, less leveraged.
The discounted valuation is understood, of course, but that discount only serves to heighten the asymmetric potential, especially when we consider the technical market structure. We really need to look closely at the highly visible short interest, which hovers around 15% of the float. That represents 124 million shares. A substantial segment of the market, the retail crowd, views this positioning as a technically coiled spring, just waiting for a short squeeze if a meaningful catalyst occurs. And this technical setup is underpinned by insider behavior. We have a clear insider-supported floor established by Director Frederick Mohn, who executed a large, aggressive block purchase, 4 million shares, at the 305 level back in September. That insider conviction at that lower boundary is a powerful contrarian signal.
I'm sorry, but I just don't accept that the visible short interest tells the complete story, or even the most important one. Focusing solely on the reported short is a classic mistake. We have to look into the shadows, specifically at dark liquidity. The off-exchange short volume ratio is consistently high, near 30%. This isn't necessarily retail-driven bearish speculation. This is highly sophisticated institutional hedging. Many major institutions hold long positions in the company's higher-yielding debt, so they use off-exchange short equity positions, often built in dark pools, to minimize market impact, specifically to hedge their long credit risk. The effect, regardless of the motivation, is critical. This persistent, large-scale short volume creates a significant structural price cap that works directly against the rapid parabolic squeeze you are banking on.
That's a sophisticated interpretation of the institutional flow, but I would argue that even if it's credit hedging, any fundamental shift in operational cash flow, say a sustained move above that $500,000 day rate, would fundamentally de-risk the credit instruments. And that would cause those hedges to unwind, providing massive technical tailwinds for the stock price. Furthermore, the market is continually pricing in consolidation. Merger rumors, particularly with a cleaner peer like Seadrill, they just persist, with retail and certain institutions speculating on a move into the $10 or even $15 range if a deal were struck. The core thesis here is that combining Transocean's premium assets and extensive backlog with a post-restructuring, less encumbered balance sheet is the logical endgame for unlocking value in the sector.
Merger speculation is often just noise, unless the financials align. And Transocean's massive leverage, it acts as a significant impediment to a clean merger. Any potential acquirer faces the daunting task of absorbing or restructuring that $6.22 billion overhang. And while Moan's purchase at $305 provided a floor, the signals from executive leadership are, they're fundamentally mixed. We saw Executive Chair Jeremy Thigpen execute substantial selling, 500,000 shares, worth $2.16 million just this December. Insiders sell for many reasons, sure, but a multi-million-dollar sale by the executive chair immediately following a period of supposed operational momentum, it suggests a concrete lack of conviction in an immediate parabolic move. It directly undercuts that whole squeeze narrative.
Well, let's move away from technicals for a moment and look at the fundamental reason this debt stack exists in the first place, because it's critical to understanding the current instability. I'm glad you brought that up, because I come at it from a very different angle. There's this pervasive myth that the debt originated from the downturn itself, forcing desperate measures. But the current structural instability truly traces back to the 2007 merger with Global Santa Fe. That transaction was not a simple acquisition. It was structured as a massive leveraged recapitalization. Existing shareholders received a huge cash payout, $33.03 per share, plus new shares. To fund that extraordinary distribution, at the peak of the market, the company took on a colossal bridge loan. And that loan became the foundation of the legacy debt stack that defines them today. I call this the original sin, leveraging the company years before the deep commodity crash.
That's a compelling historical framing. It is. And it certainly highlights the danger of financial engineering at market peaks. But context is everything. The fact that the debt was accrued during market excess and not desperation is a crucial distinction. It allowed Transocean to avoid the crisis-driven Chapter 11 restructuring that wiped out the equity of so many lesser peers later on. The company survived the most profound sector downturn in modern history without restructuring its equity, despite being saddled with that enormous legacy debt.
But a survivor that's still wounded.
A survivor that's proving its strategy is effective. Look at the balance sheet management. It is focused on managing necessary time. The successful September 2025 refinancing of $500 million in senior guaranteed notes, pushing that maturity wall out to 2032, proves that management can strategically kick the can down the road. They are buying time. Time for day rates to climb, time for the global fleet to further contract, and time for operational cash flow to eventually grow large enough to solve the problem. The key variable is not immediate principal reduction, but the ability to manage the maturity schedule until the cycle returns.
But buying time simply means incurring more interest expense. It doesn't reduce the total principal, which is still north of $6 billion. The market requires sustained proof that they can transition from just managing the schedule to actually executing sustained debt reduction. Until they demonstrate that ability to generate enough free cash flow to pay down that principal, they are merely postponing an inevitable reckoning.
They are demonstrating the cash flow generation capacity right now through strong operational execution. Let's look at the contract momentum. We've seen significant wins, like the major $130 million contract for the Deepwater Skyros in Australia. Furthermore, they keep getting extensions from cornerstone clients, notably Petrobras in Brazil. These aren't minor deals. These are large, multi-year contracts that keep their premium assets highly utilized and add significant solid backlog. This operational capability is the key mechanism for managing the debt. That backlog acts as a credible guarantee to lenders.
I acknowledge the value of those premium wins. The 7th-gen rigs, those assets capable of complex, ultra-deep-water operations like 20,000 PSI projects, they are indeed the crown jewels. However, the operational picture is best understood as a barbell risk profile. While the premium end is exceptional, the fleet still contains a substantial legacy end, older, often cold-stacked rigs. That $1.9 billion impairment charge we discussed, that was a formal admission that this legacy tail is deteriorating. Many of those rigs are unlikely to ever generate positive revenue again.
But they're being written down.
They are, but this dead weight is a massive drag on the financials. It still requires ongoing stacking and maintenance costs, even when it's inactive. This expense acts as a continuous siphon, eroding the free cash flow generated by the premium assets. It essentially forces the good rigs to operate with a much higher profitability hurdle than their post-bankruptcy peers, whose legacy fleets were just scrapped or restructured out of existence.
Even accounting for the legacy drag, the asymmetry of the trade overwhelmingly favors the bullish side. If the market continues to tighten, if global utilization for ultra-deepwater rigs breaches 90% and day rates sustain past that $500,000 mark, the operational leverage inherent in the structure transforms the equity value exponentially faster than it would for Valerius or Noble. Those companies shed the debt, but they also fundamentally altered their shareholder base. Transocean, battered and highly leveraged, is still the unrestructured survivor. The potential for multi-bagger returns comes directly from that fleet scarcity and the extreme leverage built into the capital stack.
The problem, however, remains the structural barriers. The market is efficient at pricing risk, and the immense debt wall, coupled with that persistent institutional hedging reflected in the high off-exchange short volume, will likely continue to cap the stock price in the near to mid-term. I maintain that the stock will not sustainably break out until two conditions are met. Day rates must be consistently and sustainably above $500,000, and the company must demonstrate credible action to reduce the principal of that legacy debt, not merely refinancing it every few years.
Ultimately, the stock really does function as a litmus test. It tests the market's long-term conviction in the necessity and viability of deepwater oil extraction against the accelerating backdrop of the energy transition narrative.
Operational quality and scarcity of the best deepwater assets against a historical financial burden that continues to impede capital structure efficiency. The market is just struggling to determine which force, operational success or the debt structure, will ultimately dictate equity returns.
And that is a race whose outcome is far from certain, regardless of the technological quality of their premier assets.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.